Okay, an email here from William in Toronto as we kick things off. Diamond Energy is the ticker here, is the company. The ticker is FANG on the NASDAQ. I believe this is one you've probably mentioned before.
This is one that we've owned over the last couple of years. We don't own it currently. One of the biggest changes in our portfolio over the last 6 or 8 weeks has been to reduce the exposure to exploration and production companies. This is a great company, and their production growth is remarkable. The problem is, I think that what you're seeing is some near-term concern about the price of West Texas crude, well, and frankly, Brent North Sea oil. So the producers have been backing off. Stock's actually behaving very, very well. It's not broken down technically. We have just been increasing our consumer discretionary exposure and reducing some of our energy producers.
Even in Canada as well?
In Canada and in the U.S. I think that there, very clearly is a secular theme towards volume growth, right? We're going through this enormous boom in production. In the near term, it looks like oil may be a little bit vulnerable, and so we've just backed off some of our exposure.
One of your big themes has been energy infrastructure. Here's a company in that area. Jeff's in Portland, Ontario. Hi, Jeff. Hi, Jeff. Go ahead in Portland.
Yeah, my question's on Keyera. I was fortunate enough to buy it about 5.5 years ago at $22.
Nice.
But it's now run up where I'm beginning to get a little concerned that maybe it's fully to overvalued. So I still like it, but I'm wondering what your comments would be on Keyera.
Sure. So, Jeff, you may know this has been our biggest sector weight in the portfolios that we run for the last 4 years. And Keyera is one of our top 10 holdings in the firm, along with companies like Pembina and IPL. Our basic premise is we want to own themes that have longevity to them, where the companies within those sectors can be revalued versus other sectors based on some change that's taking place. And we'll hold them as long as that continues to be the case. And we are seeing, as we've talked about a moment ago, a boom in production in both oil and gas in the U.S. and Canada. And the bottleneck is the ability to get it from the ground to the market. So one of the things that we like about energy infrastructure is it's not terribly dependent on the price of oil or gas. It's just volumes that are being produced. These are long life assets. They have been able to build additional facilities with long contracts and very predictable returns, and we don't see that changing in the near term. So these companies will continue to grow their dividends 5 to 10% a year for the next 5 years. Keyera will benefit, we think, over time, the changes in liquefied natural gas and the opportunity there. And so this is one that we would continue to hold. If I had a nickel for every time somebody told me these stocks were overvalued over the last 4 years, we'd have better returns than we've had. So I would continue to hold it. Could it pull back to $90? Sure, absolutely. But there's a very clear trend in place here. And until we see some evidence, either in the numbers or in the price of the securities that would evidence some kind of change taking place, when there's a clear long-term theme, often what looks expensive today can get more expensive in the future. And these companies are in a wonderful position.
So if nothing else, Jeff maybe wants to trim a bit, but don't get nervous and stick with the stock.
Yeah, look, these things, as I say, they can pull back at any time, but I don't think that there's any material changes taking place. We look at two things. Do the numbers support revaluation? And yes, the numbers keep getting better and they keep beating estimates. And then second, is the price doing what it should be doing, given what we think we know? And we're within a whisper of all-time highs. So we've got a lot of happy shareholders out there. There's not a lot of built-in sellers. I would continue to hold it.
Just to confirm, at that Apple event, no big surprise, Apple has introduced 2 new phones of different sizes. Moving along to Jerry. He's in Vancouver. Hi there, Jerry.
Good morning, gentlemen. David, can you please give me your view on Manulife versus the Canadian banks? I've got a significant holding, about 7 or 8% of my portfolio in Manulife.
Great.
And compared to the banks, it sucks. Its share price has gone up okay, but the dividends, lousy compared to the banks as well. Would you recommend moving out of the Manulife and into the banks, or stay the course? Right. Thanks very much.
So, Jerry, I'll go back to just the way we look at the world. We're looking for sectors that have gone through some material change. that could support outperformance going forward. This is a sector that underperformed for a long time while equity markets were weak. Manulife had their share of problems with the returns in their portfolios. But we believe that 2012 marked the beginning of a new secular bull market for stocks. So how do you make money? Well, you invest in companies that benefit from that. Manulife is in the wealth management business. We have quite a lot of exposure to wealth management. We own Manulife and other insurance companies. We own some asset management companies. And of course, we own some banks. I would tell you that it looks as though Manulife will have greater growth in earnings going forward, yet trades at a multiple that's in line or cheaper than the banks. So I think you could expect to see the dividend growth accelerate here, and I think that the earnings are going to continue to get better, and they're a global leader. So I'd own the stock. We own it in our portfolios currently, and I think the insurance and wealth management businesses look really attractive.
Thanks for that, Jerry. We'll take a short pause here and come back with David Burrows and your questions.